So let's get right into it. Welcome back to the channel, everybody. It's me, and here is how you can help us reach our goal of 3 million subscribers by the end of the year. Hit that subscribe button right now and then stay tuned for a new episode every Wednesday and Friday. Now, while reading through some of the comments on last week's video about Fire Festival, I found one particular comment that stood out to me. Specifically, it was about how you're never gonna get rich working for somebody else. And while I do agree that building your own business and scaling that business is probably going to be your fastest way to achieving wealth, that doesn't mean that working for somebody else won't make you wealthy. Plenty of people have become multimillionaires and even billionaires by working for somebody else. But what I think the person who left that comment was getting at was the fact that oftentimes working for somebody else you gonna end up getting exploited. Your efforts are gonna go unnoticed. You're not gonna get the credit for the work you do. And in many cases, you're going to be working your tail off for little to no reward. I know, I've definitely been guilty of this in the past. If you check out my early videos, you'll see that I spent a lot of time talking about all the ways I was being exploited as an employee. The problem, though, is if you're spending all your time complaining about how you're being taken advantage of, that's not going to change anything. In fact, that's only going to make your situation worse because as an employee, you're at a disadvantage. You have little to no leverage over your employer. Your job is either going to be 1. Terminate you immediately and find somebody to fill your position, or to endure you whining about things that are really under their control and continue to have poor performance reviews because you do only have the motivation to do a good job. In this episode, I want to talk about one of the biggest scandals involving corporate greed and fraud in history, and it involves a man named Bernard Lawrence Madoff, aka Bernie Madoff. Bernie Madoff was born in 1938 and had a relatively normal upbringing in New York City. He wasn't rich by any means, but was always interested in finance and the stock market. From the time he was 12 years old, Bernie wanted to be involved in investments, and so he started doing odd jobs, like mowing lawns and fixing shoes, which he would take the money he earned and use it to buy penny stocks. After graduating high school in 1956, he went on to attend Hofstra University in Hempstead, New York, where he studied political science. While attending college, he worked part-time as a clerk at the NASDAQ stock market. Bernie graduated from Hofstra in 1960, and by that same year, he would co-found the company that would later become his infamous investment firm. For the first several years, Bernie Madoff ran a more traditional brokerage business. That meant that when a client came to him looking to invest, he would put their money into stocks, bonds, commodities, and other financial assets and then give them a portion of the profit. Now, while Bernie was able to make money for his clients, he was nothing special. Just one of hundreds of brokers in the area. However, after the NASDAQ experienced significant growth throughout the 1960s, Bernie realized that he needed to do something extraordinary to stick out from the crowd if he wanted to grow his customer base. And that's when Bernie came up with his famous split-strike conversion model. Now, to be honest, I'm not quite sure if I fully understand this model myself. It is very complicated, and even the SEC admits that they still have figured out the exact mechanics of how he pulled off such high returns without taking on any real risk. But here's what I understand. The way Bernie explained it was that his team of analysts would purchase both call options and put options for various securities. The calls would generate upside potential, and the puts would limit the downside risk. To make things simple, calls are an option that gives you the right to buy something at a set price, while puts are an option that gives you the right to sell something at a set price. If you're interested in learning more about this topic, I do recommend that you watch a video that explains it in much greater detail. The video will be linked in the description box below. Whatever the case, all investors really cared about was the fact that Bernie claimed his portfolio always returned around 1%. Every single month, regardless of what the market was doing. And that promise alone was enough to convince thousands of investors to hand over their money to Bernie to manage. Now, one of the reasons that Bernie was able to lure in so many investors was because of his reputation. Not only was he the former chairman of the NASDAQ, but he also served on the board of several prestigious organizations. And to top it all off, he was known for being extremely generous when it came to charity. Over the years, he donated tens of millions of dollars to universities, hospitals, and various other foundations. And because of all these relationships, Bernie was able to learn the names of many of his investors, and that helped him build trust with them. In the 1990s, Bernie Madoff's net worth skyrocketed. He moved his office to a 44-story skyscraper in Manhattan and was able to charge a premium for his investment strategies. He built an inner circle of about 200 of his wealthiest clients, who each had to have a minimum of $10 million invested with him in order to participate in his exclusive investment plan. During the 1990s, Bernie managed to attract a number of well-known investors, including Kevin Bacon, John Paulson, Carl Icahn, Steven Spielberg, Jimmy Buffett, Peter Lynch, and even the estate of Ted Kennedy. As his net worth increased, so did his donations to charity. In 1991, he was awarded the Israel Bonds Humanitarian Award for raising $1 billion for the state of Israel. Later that decade, he would receive the Lifetime Achievement Award from the anti-DDoS. As the dot-com bubble heated up in the late 1990s, so did his returns. According to his reports, between 1990 and 2000, his fund delivered average annual returns of almost 18%. And then when the dot-com bubble burst in 2000 and the market continued to decline throughout 2001, guess what? Bernie's fund saw positive returns of 10.2%. Even after the September 11th attacks, as other investors panicked and sold their positions, Bernie reassured his clients that everything was okay. And those who listened to him and held on to their investments would see an 11.8% gain in 2001. Fast forward to 2008, the housing market has reached its peak. Investor confidence is at an all-time high, and that year, Bernard L. Madoff Investment Securities would manage more than $60 billion in assets. Everything seemed to be going well. But behind the scenes, Bernie was panicking. See, unlike other hedge funds, Bernie didn't actually invest his clients' money. There were no trades being executed on their behalf. And so whenever one of his clients requested a withdrawal, he was forced to pull money from the funds of newer investors to pay them back. As the inflow of new money started to slow down, Bernie began raiding his personal accounts to cover with, and once the market started declining, he was forced to liquidate his stock portfolio, which he used to buy back his clients' shares. Soon, he was so deep in debt that he was borrowing money from friends and family in order to cover withdrawals. On December 2008, two of Bernie's sons discovered that their father was running a Ponzi scheme. At first, Bernard refused to admit it. He even told them that the secret to the scheme was to get the media on your side. But within 3 days, Bernard changed his mind. He called up his lawyer and instructed him to tell his sons that he was sorry, that they should take care of their mother, and that he loved them. He then admitted to the FBI that he had lied to his investors about his returns, and that he kept their money in a separate account from his firm. After the admission, he was quickly arrested and sent to jail where he would remain for the rest of his life. But why? Why did Bernie do it? Throughout Bernie's trial, his lawyers tried to portray him as a Robin Hood-type character who used his wealth to benefit charity and who gave his clients great returns. But the judge wasn't having it. The judge stated, "You betrayed the trust of a lifetime. You ruined thousands of lives, and your crimes may never be fully known. Your fraud is the largest in history." On June 29, 2009, Bernie Madoff was sentenced to 150 years in prison. I hope you enjoyed this video. If you did, I would appreciate if you hit that thumbs up button. It helps a lot. Also, please consider subscribing. We're trying to reach a milestone by the end of the year, and none of that would be possible without you. Thank you guys so much for watching, and until next time, stop settling and start thriving.